So what happened in the real estate market over the past month? Well, let's talk about it. Let's see what actually occurred, and let's see what the hyperbole is that's out there. I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people buy and sell homes. We do every month a real estate market update for the Las Vegas Valley, concentrating on single family resale residential properties. I do a companion video to this one which concentrates on condos and townhomes or multifamily residential resale in the Las Vegas Valley, and that video is linked at the end of this one. And this video looks at residential resale single family in the Las Vegas Valley for the month of September of 2022. As I record this on October 8th, I'm using the data that was available as of October 7th. So we have a fairly stable view of what took place in September. So I know sometimes my videos get a little bit long. I'm going to try to keep this one a little bit more contained in terms of size. So let's go ahead and dig right in. But before we get to the numbers themselves, a couple things. One, I ask please smash the like button, please subscribe, and here's a little reward for you for doing so. Now that we've got that out of the way, let's talk about some of the macro conditions underlying the housing market so we can set the context for what we're actually looking at here. So during the month of September, the Fed, the U.S. Federal Reserve, has continued its aggressive stance of monetary tightening by way of raising the federal funds rate. And you'll remember the federal funds rate is the only interest rate that the Federal Reserve directly controls. It's an overnight lending rate. But by that tool, that federal funds rate, the Federal Reserve signals to the rest of the interest rate markets, the bond markets, what they would like to be going on in the economy. They'd like to have interest rates moving up. They'd like to have them stable. They'd like to have them moving down. Well, as the Fed increases the federal funds rate, they're signaling they want interest rates going up. And what that does is that actually tightens monetary policy. It effectively allows for fewer dollars to be circulating through the economy. Now, there's a couple of intervening mechanisms that get utilized to actually control the money supply, the M1 or the M2 money supplies. But it reduces effectively the money supply by reducing the multiplier. So what that means is every dollar that goes into the economy is spent more than one time during any particular period. So if I hand somebody a dollar bill, they're likely to go and spend that dollar bill. Or maybe they put it in their bank lends out that dollar, somebody else spends that dollar, right? And that dollar then, having been spent by somebody else, goes back into circulation. Let's say they spent it on gas, and that dollar is sitting there at the gas station. Well, the gas station gives that dollar as change to somebody else. That person then goes and spends that dollar again. The number of times that dollar circulates through the economy is referred to as the money multiplier. And and we can get an aggregate number for that, understanding how many physical dollars there are and how large the economy is, we can actually calculate how many times each one of those dollars circulates through the economy. That multiplier can be increased or it can be decreased. By increasing the multiplier, we accelerate the number of times that dollar circulates through the economy. The more frequently it can be spent, the more economic activity there is. If there's a way to pull down that multiplier, what we actually are doing is decelerating the number of times that dollar circulates through the economy, and consequently we're pulling down the level of economic activity. As the Federal Reserve increases interest rates, That makes the borrowing of money more expensive, which means that dollar, once it went into a bank, for example, it's waiting a longer period of time to be lent to somebody else because demand for borrowed funds has gone down. Well, that means that the multiplier on that dollar has also come down. It means that the number of dollars circulating through the economy during any given period of time are going down. So the Federal Reserve increases interest rates. They signal to the bond markets. That means they want all interest rates to go up. As all interest rates go up, not only does money become more expensive to borrow, but because it's become more expensive to borrow, the number of times that composite groups of money are borrowed reduces. Therefore, the multiplier goes down and the level of economic activity inherently falls along with that. So the Federal Reserve has made it very clear they want to tighten. Earlier this year, they had been claiming, well, there may not be a recession because of our tightening policies. And then they were saying, well, maybe there'll be a recession, but it should be what they refer to as a soft landing, a very mild, very short recession. Over this past month, the Fed, in its public comments, and all of the governors, frankly, all of the voting governors of the Federal Reserve who set monetary policy, they have all made it abundantly clear they now believe we will be entering a recession if we're not already in one. And they don't care how deep that recession is going to be because they are singularly focused on eliminating inflation. And you can go back and look at last month's video, the video from the month before, and a couple before that. I have been saying the singular focus on inflation is misguided, it's misplaced. It's actually not solving the underlying inflation problems that exist in the US economy, and therefore it's destined to have significant problematic effects. It will increase interest rates. That's the policy tool. That increasing interest rates will drive down economic activity. That's the direct intended consequence. That will increase unemployment because fewer people will be needed to make or provide goods or services into the economy when there's less demanded. That increased unemployment level will drive down economic activity further as the unemployed are able to spend less money in the economy than are people who are employed. And that will have a significant lowering effect on aggregate demand in the economy. Now, that lowering effect on demand will drive down inflation. If there are fewer people chasing after goods and services, then those who are actually still able to buy those goods and services will experience lower prices, right? So if there's only 10 TVs in a store and 100 people want them, prices on those TVs are going to be pretty strong. They may go up a little bit. If there's only one person that walks into that store able to buy a TV, wanting to buy a TV, and there's 10 of them, those TVs are going to go on sale. That means the price of TVs is going to go down, right? And so we eliminate the inflation, we experience actually deflation, decreasing prices, which may sound nice at first, but actually as a macroeconomic issue, deflation is vastly more problematic than inflation. And so the Fed generally would like to see inflation at around 2%. The goal actually had always been, until fairly recently, inflation between 2 and 4%. So this extreme focus on 2% inflation is a little bit weird in and of itself. But the Fed's preferred gauge of inflation, the PCE, personal consumption expenditures, X energy and X food, meaning not including food or energy prices and changes in those prices. That's the Fed's preferred gauge of inflation. And at the end of August, that gauge was running at 4.9%. Interestingly, now that means that inflation is just barely above what had historically been the Fed's preferred target, inflation in 2 to 4%. So yeah, we're way above the 2%. We're just slightly above the 4%. Most of the experience of inflation that we have in the economy right now is actually coming from the three top headline numbers: energy inflation, which is related to, largely right now, war in Ukraine, or for those of you who insist, special military operations going on in Ukraine, and the way in which OPEC plus, the OPEC members and the allied members of OPEC, which include Russia, have decided to eliminate an additional 2 million barrels of oil production every single day from the global economy. That's driven up and will continue to have significant influence on oil pricing, which of course oil gets refined, becomes gasoline, becomes home heating oil, becomes diesel fuel, becomes jet fuel, etc. So oil prices are elevated, and there's some inflationary pressure on oil, although interestingly, oil prices have sort of stabilized in a particular band of sort of $82 to $90 per barrel. They may fluctuate a little below, a little above, but they've come down significantly from about $120 per barrel at the beginning of the Russian invasion of Ukraine. Now, they've come down partly because the current administration, the Biden administration, has decided to release oil from the Strategic Petroleum Reserve. And by the way, the Strategic Petroleum Reserve was created in the 70s because of OPEC oil embargoes into the US, creating significant problems in the US economy in the 71, 72, 73, and 74 timeframe. And so the Strategic Petroleum Reserve was created at that time, and it's effectively very large underground storage locations which hold hundreds of millions of barrels of already extracted oil that can be pulled out of the ground very easily and simply piped to different locations for use, for refining into consumable products. In addition, the US is actually the largest oil producer in the world, meaning more oil comes out of the ground in the US every single day than comes out of the ground in Saudi Arabia or Russia, the number 2 and number 3 oil producers. So oil is problematic, but it's no longer going up, which means that gasoline prices should not be going up. And in fact, they've been trending down, which means that inflation is coming down because the energy component of inflation is trending a bit lower. Now, of course, nothing comes out of the ground, meaning crops, foodstuffs, that doesn't take some level of oil to run the tractors, the harvesters, the planters, etc., and then ship that stuff to distribution points, to wholesale points, to cleaning points, and to retail stores. So as energy comes down, energy prices come down, food prices should stabilize and start to come down a little bit as well. So that leaves the third major component of inflation, which is housing. So what's going on with housing? Well, remember, only part of the housing portfolio, if you will, calculates into inflation. Housing as an owned asset is not inflation. It's appreciation or depreciation of an asset class. The only housing that really counts toward inflation is rent, or owner's rent equivalent, which effectively is a survey-based number that's looking at what rent would be for an owned house. Well, rents are going up. Rents are going up. Why? Because there are supply shortages for housing. Now, here's where the Fed is making a very weird mistake with regard to their policy. As interest rates go higher, it becomes more expensive to build housing. It also becomes a little bit harder for those who've already contracted to buy a house to actually execute on the purchase contract that they had signed. Meaning some buyers of new built homes are falling out of contract and developers are being saddled with inventory they did not recognize they were going to have. They thought they'd pre-sold a house before they started building it, but it dropped out of contract and now they have to sell it again, which means they have to keep their office staff, their sales staff around longer. They have to pay for the utilities on a house that are already sitting there. They have to pay the interest expense on the construction loans that they thought they were going to be paying off as soon as the house was ready. In consequence, developers have started taking defensive actions. New home builders have stopped buying land where they can build new houses. So land becomes a constraint on them. They'll build the existing developments they've got, but very few new developments are now opening. And the pipeline for where those new developments could open going forward becomes smaller because the developers are not buying the land. Whether that's from the Howard Hughes Corporation to build in Summerlin, whether it's from the Bureau of Land Management, wherever they would normally buy land from, they've largely stopped buying that land. They also have cut down on requesting new building permits. No new building permit, no new housing start. Housing starts subsequently have fallen as well. And almost every month this year, we've seen housing starts, that's the actual start of construction on a new house, have fallen off. And it's because net sales of new houses have fallen as well. So when a builder executes a contract with a potential buyer, that counts as a new home sale. However, some sales fall out. And so actual sales, actual contract signings with developers, minus contracts that have fallen out, is referred to as net new home sales. So that's measured actually differently than if we're looking at the resale market, where a buyer and seller sign a contract. There's a pending home sale. There's not a home sale, pending home sale, until we get to the actual close. So there's not such a thing as a net new home sale because all existing homes are net purchases. They're actually purchases that completed. That's how they get reported. In the new home space, it's reported differently. It's contract signings and then it's net new home sales. So what we're seeing are permits are down, housing starts are down, contracts are down, and net home sales are down in the new home market space. That means developer activity is slowing. It means fewer new housing units are coming into market. And those housing units might be single family, they might be condos, they might be townhomes. They might be things that look kind of like apartment buildings. In fact, they could be apartment buildings. That's actually, it's not subject to sale the same way, but those would still be permits required and housing starts required, right? And those are all coming down. That means the shortage that we've had in the rental housing market will continue to get worse, which means pricing pressure because of demand, pricing pressure on that non-increasing supply of rental housing will continue to push rental prices higher, which means that there's additional inflation, which is doubly problematic because one, we get the additional inflation, and two, the Fed's preferred inflation gauge is PCE exclusive of fuel and food, but it includes housing. So as the Fed pushes interest rates higher, they're actually inducing inflation. And that inflation is being measured in the Fed's preferred gauge of inflation. It makes it harder for them to fight the very thing that they think that they're fighting. As well, it does nothing to help with supply in other areas of the marketplace because it's having the same kind of impact in those other areas of the marketplace. It's just that we're focused on housing, and so I explain it specifically with regard to housing. Now, how much is the Fed pushing the interest rate. How high are they intended to go? They've already declared that their prior announcements of policy rate increases, Fed fund rate increases, have not been sufficient, and therefore they intend to increase interest rates twice more this year and probably increase interest rates next year, or at least not lower interest rates next year. What that means is the 10-year Treasury, it's a federal government bond, which is issued for the government to be able to borrow money that's used to pay for government goods and services, and salaries, other things like that. That 10-year Treasury yield, the yield, has been going up, and it's now hit the highest level that it's been at since just prior to the financial crisis that started outside of Las Vegas in 2008. And in fact, interest rates for mortgages have also gotten back to pre-2008 levels. Now, it's kind of interesting, right? We started this year, we ended 2021, started 2022 with mortgage interest rates right about 3.0%. And over this past 2 weeks, we've seen mortgage interest rates up at around 6.5%. Rates for mortgages have literally doubled. Now, what does that mean? Well, we'll talk a little bit more about what it means is related to housing specifically as we go through some of the numbers in just a minute. But it does mean, at the very least psychologically, buyers are being shocked at how much they're having to pay for loans. And this is being amplified with problematic reporting in the news media and especially on social media. And it's causing some people to simply become fearful and pull back from the market. Now, in reality, 6.5% mortgage interest rates, yes, it's a shock from where we were 12 months ago. It's a shock from where we were 10 months ago. It's actually historically not high. It's a little bit on the low side. And of course, you can always borrow money, refinance. You can always borrow money, make payments. And most people don't own a house for 30-year period of time. Most people actually own a house for 3 to 7 years of time. And so you're making payments with a higher interest rate, but you're making payments with a higher interest rate, maybe not for as long as initially you're thinking about when you're in the mortgage market and you're looking for loans. And by the way, I will say, with the level of fluctuation in mortgage rates between banks, and given that interest rates do not increase in a straight line, except possibly the policy rate, the Fed funds rate, interest rates tend to fluctuate. And we've already seen mortgage interest rates start to come back down after this last Fed funds increase, just because the bond markets tend to move based on expectation of news, and then they reverse based on the actual news. But it means that rate levels, interest rate levels between lenders are more variable now than you might have normally expected to find. And so you should be shopping for mortgage interest rates, mortgage loans, when you're shopping for a home. And if you don't know exactly what that means, that's fine. Talk to your real estate agent. We'll be happy to explain it. We'll be happy to introduce you to some lenders who we know are out there aggressively trying to get mortgages and who are writing with really good rates. But I have seen some of our clients over the past month or two get into mortgages that have been just over 4%. And we've seen people being quoted from other lenders at a bit over 6%. So that's a pretty substantial difference. There are ways to actually get better rate mortgages if you do some shopping around for lenders. All right, so that's the background. Interest rates are generally speaking going up. At the market forecast, the 2022 market forecast video I did last year, about 10 or 11 months ago, I had suggested, I thought interest rates in 2023 would probably be going up, and they'd probably get up to between about 5.5% and 6%. So we're just a little bit above that right now. I suspect interest rates are actually going to be staying, mortgage interest rates are going to be staying right around 6% for the remainder of 2023. We will spike above that. We'll come back down a little bit from that. But I think we'll sort of see an average between beginning of October and end of December over the fourth quarter of this year, mortgage interest rates averaging at about 6%, 6.0%. So I don't see a lot of, unless you happen to lock in a bad week, I don't see a lot of problems on the mortgage interest rate side from here forward. Now, having said that, clearly mortgage interest rates at this level are scaring some people. The news and the social media are scaring a lot of people around whether or not they should be buying right now. And it has had an impact in the market as we're experiencing the residential resale market this year. So let's turn our attention to that now. And let's look at what's going on specifically with residential resale of single family houses in the Las Vegas Valley. Now, the first number I want to point out is the price. And I'm going to report to you the median sale price for single family resale residential came down last month, over the month of September relative to the month of August, and we ended September at $440,000. That's down $5,000 from the $445,000 that we were at in August. So just over 1%, 1.1% decrease in the median sale price. Now, I want to point out that if you read the press release from Las Vegas Realtors, if you read what is stated in the local news media, prices were flat last month at $450,000. And I just want to make this comment, that's because they are not segregating out resale and non-resale. In the resale market, single family residential came down $5,000. So there's a little bit of news media right now that's actually reporting overly positive spin on the data. And I don't want you to be confused by that. They are telling you that those new construction properties that happen to go into the MLS are included in resale data and should be. They should not be. If you include them, median sale price in August was $450,000 and in September was $450,000. But they're not actually resale properties. The way this gets justified by the people at the Las Vegas Realtors Association, who apparently do not understand statistics, and everyone who they report to, who most all of them apparently do not understand statistics, is, well, it's a resale heavy database and therefore the other ones don't matter. And that's not correct. It's a resale heavy database because that's specifically what it's meant to be. And because it's resale heavy and it's meant to be about resales, all of the other data is noise from a different population, and therefore it is improper to include it in an analysis. It's fine to include it in a new construction home gets listed into the MLS. That's a good thing, and it's fine to include that in the data set. But it's not appropriate to include it in an analysis of the data set. It is a separate population of data, and it simply corrupts our understanding otherwise. So actually prices came down a little bit during the month of September. Came down 1.1%. Now, we are up 8.6% from the $405,000 median sale price that we were at the end of September of 2021. Okay, so we were up $35,000 from that, or 8.6%. And interestingly, even though there's been this supposedly crashing year, we're actually up 3.5% year to date, from $425,000 on January 1st through September 30th. We're up 3.5%. We're up $15,000. So not bad, right? If we're supposedly crashing, if the market is just horrible, everything is tanking, no sales taking place, the economy is broken, blah, blah, blah. Actually, the housing market's looking very stable. And that's significant to think about if you're thinking about where do I invest my wealth, right? Beyond the where do I get the best return, which is generally housing, and beyond the what are the tax consequences, where housing is almost always the best investment you can make. If you're thinking simply about where do I put my money to protect it, actually real estate this year has been a fantastic place to protect your money. All right. Now, I also look at the price per foot when I'm doing the single family residential resale video, and price per foot came down this past month as well. Now, remember, this is the median cost per foot for single family resale. Came down to $246 per foot. That's down 3.1% from $254 per foot in August. Now that's a steeper drop than what we saw on the median sale price, and that suggests that we've actually got a little bit more activity starting to take place in the lower half of the market, and maybe a little bit less activity in the upper half of the market. And I want to talk more about that in just a second, but I want to give you the annual change here as well. At the end of September of 2021, we were at $223 a foot, so we are up 10.3% from that $246. We are up 8.6% on median sale price. So on a price per foot, we're up just a little bit more than at the median, but this past month has taken the median price lower. Now, why is that important? Because it tells us something about the makeup in the market. And as we start to see prices that are, properties that are priced in that lower half, because the median sale price is the middle point of the market, in the lower half, we get more activity there than in the top half of the market. We see the median price per foot coming down a little bit faster. And so that's what's taking place. Well, why would that take place? On the one hand, we may think those people who are buying at sort of the median or a little bit less are more likely to need a mortgage than those who are buying sort of at the middle point of the market and higher. That may not be completely true. It may actually be that at the middle point or lower, there are more people who could buy with cash. And so maybe they're a little bit less exposed to the interest rate issues in the market right now. Maybe not, but speculatively, we might speculate that way. But here's something else. And this is another problem with what the Fed is doing. Economists like to talk about the wealth effect. When people hold assets and the value of those assets goes up, especially if they go up in ways that are unexpected or levels that are unexpected, those holders of those assets experience the wealth effect. That means that they feel wealthier. They actually are wealthier, but they feel wealthier, right? So imagine this. You have a car, and for some strange reason, the car you have has just been declared a collector's item. And it was worth, in the resale market, maybe $20,000 last week. So nice car, but not a super premium vehicle. Couple years old, worth $20,000 in the resale market. But it was just declared a special limited edition collector's item that no one had realized at the time. And your car goes up in value, and you're kind of curious, you look it up. Wow, your car is $80,000. Now, that's kind of interesting. You just became $60,000 wealthier than you had been yesterday. What do you do with that? Well, you could go sell your car that was worth $20,000, take the 80, buy a $50,000 car, pay off $20,000 in debt, and go on a $10,000 vacation. Is your wealth increases, your feeling of wealthiness increases, the wealth effect. When investors in the stock market see the value of their assets in their stock accounts going higher, they start to feel more wealthy. The problem is there's an inverse to that as well. Well, who holds most of stock in this country? And this is a statistical reality. This is not a criticism of anything. Most stock in this country that's held by individuals is held by wealthy individuals, people who are in the top 10% of the wealth strata in this country. And so when the stock market goes up, those people experience a wealth effect and they start to spend money according to their new perceived wealth. People who do not own stocks are less susceptible to that. But if we look across these strata of sort of top 10%, or actually let's take the 20 percentile and the 40 percentile and the 60 percentile. Right? We'll leave out the wealth strata or the net worth strata of the bottom two 20 percentile categories. So we've got the middle class strata in there. The overwhelming majority of their wealth, an individual level and at a collective level, is in their real estate, not in the stock market, nor in their special edition, limited, very expensive cars. And the interesting thing about that is that means that over this past couple years, as the price of their homes have gone up, a lot of Americans have started feeling wealthier. And they've been taking some of that wealth, refinancing it perhaps out of their house, or just spending forward what they thought they would be able to make at some point in time. And they've been spending it as if they were more wealthy, because in fact they were. They were experiencing the wealth effect. Well, as the Federal Reserve has decided to increase interest rates in ways that are slowing demand in the housing market, therefore potentially pushing housing prices lower. And we have actually seen prices come down, a peak of 480 in May of 2022, down to now 440. So approximately a 9% drop. We've seen that the median house come down in value. Well, that's destructive of wealth, and that causes a negative wealth effect. And that means that there are a lot of people out there right now who are holding property, probably their primary residence, maybe a second home or a rental property. They're starting to feel considerably less wealthy, which causes them to pull back on the various expenditures that they're going to make. So this is a combined problem that the Fed is inducing, because the impact that they're having right now in the overall marketplace with Fed funds increased interest rates is they're actually making people, the middle class, feel less wealthy, specifically in that category of assets that they hold the greatest percentage of their net worth. That's a problem. It's actually a problem. We'll see how that manifests itself over the next 1 or 2 years. Is that problem of how you make people feel wealthy, not wealthy, increasing in wealth or decreasing in wealth, has a strong psychological effect on how they spend money. So it'd be kind of interesting to see how that plays out. Now, are any houses selling? I know that I just told you prices have come down slightly, about 1.1% over this past month, but are any houses selling? Last month I had suggested I thought September was going to be stabilizing for the number of houses that sold. I thought they actually might go up very slightly. So here's the data. I was off by 14 houses across the whole valley 2.4 million people. I was off by 14 houses. Houses sold 1,841. That's down from 1,855. It is down 0.8%, or 14 houses. So effectively completely flat, August to September. We're not seeing a decrease in the level of buying and selling activity in the valley at this time. Now, we are down a lot from last year. Of course, last year was the strongest year for sales in the valley, in literally the housing history of the Las Vegas Valley. So we're down 41.6% from that, but it's a meaningless number, as I've alluded to over the last several months. What about pending home sales? This is contracts that have been written. Buyer enters into a contract with the seller to exchange a home, but they've not yet closed. They don't yet count as sold. So this number is a little bit challenging. The number of pending fell to 1,821. Now that's approximately the same as we saw for sold, but it's down from 1,972, so down 151 from the August pending number. That's down 7.7%. Why did pending fall significantly in the month of September? New contracts in the second half of the month started to slow down pretty considerably because of the additional rate hike that the Fed imposed on the Fed funds rate. Another 75 basis points, 0.75%. And that started to spook potential buyers again. And so that pulled down the pending from where we otherwise would have been. If rates had stayed stable, I think that we would have had a pretty decent pending number as well. Now, again, that's down a lot from where we were last year. Again, with super strong numbers last year, we're down 41.2% from last year. Now, this pending number, remember, this is looking forward. This is what we would expect to be seeing sold in the month of October. Now, October, I had suggested a couple months ago, I thought October would look pretty decent. But because we've got the Fed saying, hey, we're still increasing interest rates 2 more times this year, and we just increased rates near the end of September, October is going to be a little bit more challenged than I had suspected that it was going to be. And November and December are always seasonally low. So I don't think we're going to see a really fantastic Q4, fourth quarter in 2022. I think, though, when we get to the beginning of 2023, things are going to start to turn around and we'll be on a trend that looks like the kind of trend that we started to put in place otherwise in the month of September. So, what about, also looking forward in time, how much inventory is there? The number of homes for sale at the end of September of 2022, 8,362. And I know that sounds like a lot. In reality, it's actually only about 80% of normal. Not of balanced market, but of normal. Normal, we're looking at around 10 to 11,000 houses in the market at any time. 8,362. That's actually down. It's down 3.6% from the 8,672 that were in the market at the end of August. This is the first decrease we've seen in actual listed inventory since January, when inventory came down by a couple houses from what it had been in December. And inventory in the December-January timeframe is usually the lowest that you see during an entire year. So inventory coming down in January was expected, although the decrease in inventory at that time was very, very slight. We're down 3.6%. We're down 310 houses for sale in the Las Vegas Valley in September, at the end of September, relative to where we were at the end of August. This is significant, and I've alluded to this over the past 2 months, and especially last month, is we're going to start to see inventory coming back down. Why were we getting really strong price appreciation last year and the year prior? Because of low inventory. And if you go back and you look at my videos from prior, well, actually from like October of 2020, I comment in, I believe it's that video, that it's the very first time I had ever seen inventory come below 5,000, actually below 5,000 plus, because that's the highest number that gets directly reported on the search screen in the multiple listing service. So to see the actual numbers above that, one has to go and do considerable more in-depth research to see anything that's above 5,000 plus. And we suddenly in October of 2020 had dropped below 5,000 plus for inventory. Normally inventory is between 10 and 11,000. Well, we're not below 5,000 yet, but we're now trending back in that direction. Our home sales this past month were down by 14, but our inventory was down by 310. Inventory is going to start coming down. Now, supportive of that information is newly listed in the market. So these are resale homes that are newly listed into the market for sale. They're new inventory. That number, 3,399, that number is also down from the prior month, 4,053. That number is actually down 16.1%. One of the reasons we start to see inventory come down is because we start to see fewer people interested in listing their properties. Why are they less interested in listing their properties? Well, one, interest rates have gone up, and so they're going to have to pay more to buy a new house, a different house. Two, they've got a really low interest rate on their existing home, and they don't want to have to pay more to get into a different house, a higher interest rate, because there's a psychological attachment to that, which in and of itself is maybe problematic, but it's still true. So those are two reasons. Third reason, negative wealth effect. People feel less wealthy. They start to pull back on the activity that they engage in. Now, it's not only purchase activity, it's sales activity. This is why I said there's a secondary follow-on effect from what the Fed is actually doing right now that we're going to have to see how it plays out in the actual marketplace, but it's potentially pretty destructive. It's destructive of supply at the very least, even for the existing houses. So as we see newly listed down 16.1% month over month, we see it down 11.3% from the 3830 that were listed in September of last year, right? Remember last year, record volume in almost all of the categories, not so much in new listings, but we're down from the new listings that we had last year. So inventory lower, new into market lower. We're starting to see some interesting challenges creep into the market here, and those challenges are going to lead to higher prices. Now, how can that be higher prices if interest rates are going up? Won't housing become unaffordable? I've said multiple times, I'll say it again, affordability is an illusory concept. It's kind of meaningless for a lot of reasons. There are all sorts of ways to get around affordability. But let's just take a look at what the actual numbers are for buying and owning a piece of property right now relative to where we know we had gotten to at some point in time in the past. In June, and I've said this for the past couple of months, we'll just do it again. In June of 2006, here in the Las Vegas Valley, we'd hit the cycle high on pricing, right? This past cycle that we're correcting from right now, we're not crashing from, we're correcting from, was 480,000 in May of 2022. And so that'll be a number that we'll talk about going forward in time frequently. Right now, that previous cycle high was June 2006, And on an inflation-adjusted basis, that number, which was reported as $314,700 in June of 2006, that number in current dollars, 2022 dollars, is $448,000, $448,800. Right, so we're below that right now, right? We're below it by $8,800 because our median in September of 2022 is $440,000. So the June 2006 high was $448,800. Plus the interest rates were actually higher. Average interest rates at that time, 6.75%. If one took out a 90% loan-to-value loan on the median house at the average interest rate in Las Vegas in June of 2006, that monthly payment would have been $2,595. If we take the current median sale price, $440,000 at the end of September, at the prevailing interest rate at the beginning of October, 6%, and we took a 90% loan-to-value loan on that median home at that average interest rate, we'd be paying $2,256 per month. That is $339 per month less on an inflation-adjusted basis, $339 a month less than was the payment in June of 2006. And yes, certain other costs have gone up from what they were then, but on an inflation-adjusted basis, actually HOA fees have come down. Homeowner property insurance has come down. Right? So one would actually be paying less money right now, something actually pretty close to $400 less per month right now to buy the median home than was true in June of 2006. Kind of interesting. Will prices go up even at these interest rates? Yeah, they will. They've been higher before. Prices literally on an inflation-adjusted basis have been higher before, and monthly payments have been higher before. Is there room for prices to go up? Yeah, they will be going up. And as inventory comes down, as new listings come down, as new construction comes down, we are headed to renewed inventory problems, supply challenges in the housing market that will push prices higher. There's no question about it. Now, one other number that I have been looking at for the past little more than a year, is the number that have come back in the market. That number, 857, housing contracts for the sale and purchase of a resale house in Las Vegas, 857 in September of 2022. That represented 31.8% of all contracts, ones that actually closed during the month and ones that failed during the month. That has come down from 33.3% in August. Now, I've said I think this is a trend of slowly decreasing back on market numbers. And I think that's correct, although in the multifamily segment, we actually saw some increase. We do have some appraisers out there who are becoming very confused about what's going on in this market. And they're listening to the news and the social media and they're thinking collapse. And that's not what's going on. That's not what prices are showing. But it means that we do have recurrence of appraisal problems taking place in this market. And so it's something to pay very careful attention to. So if you're a seller, you want to make sure that your real estate agent is getting you out there at the right price, getting you into the market with good timing and an expectation that the whole sales cycle right now is slower. Your house is not going to sell with 15 offers in 3 hours. It's going to take a few weeks. It's going to take a few months because the whole market has slowed down. But as well, you need to have your agent making sure they're protecting you with regard to appraisals, with regard to the other issues that cause contracts to fall out and your property to come back into the market. give us a call. We've been very successful with getting houses sold. We've been very successful with keeping pending contracts pending and closed as opposed to losing those. If you're a buyer, your inventory choices are higher than they were last year. Prices have come down a little bit since May, although they are not coming down rapidly, and they have not come down to where they were last year. We are up 8.6% from this time last year. We are up 3.5% from the beginning of this year to present. So don't think you're going to be getting a steal on a house. There are some definitely mispriced houses on the low side, but the most houses are either priced approximately right, or they may be priced a little bit high. There's maybe room for some negotiation. You've got some inventory to look at. And things are not selling super quickly, so you've got a little bit of time to think about things. But don't be scared about this market. Work with an agent who understands what's actually going on, who can help you get into contract, who can help you find what you want to get into contract on and get you into that contract and get you through that contract so that you're owning a house and paying less money for it than you would have been back in June of 2006, both in absolute dollar terms and in monthly payments than you would have been in June of 2006. Or the months prior to that, or the year subsequent to that, if you'd gotten into the housing market at that time. And by the way, for those of you who are fearful that if you buy now and housing prices still come down for another 3 months, because I said it may be Q1 before we start to see some real change in the marketplace. If prices come down by $2,000, but you got into the house you wanted to be in, and you made a mortgage payment, 2 mortgage payments, 3 mortgage payments on that property, and each of those mortgage payments sent $100 into equity, your $300 of savings, you've spent no more than you would have on rent. You had access to a little bit more inventory than you will when we get to January, and you don't know how quickly prices are going to go up then. This is not a market to be afraid of. It's a market to find somebody who has the right knowledge and who has the skill to help you succeed in this marketplace. So please reach out to us, give us a call. I'd love to work with you. I'm Justin Miller with the Chong Miller Group. We help people buy and sell homes. Thank you.